See what our THOR indicators are saying right now and what area is going to do very well for the next several years. Hi, Jim Gore from THOR Wealth Management. Well, 2025 is in the bag, so let's see what the THOR indicators are saying for the start of 2026. First and foremost, we look at the THORdex. Now, the THORdex, as I mentioned before, is not a market timing measurement, but what it is it's a risk measurement, especially of U.S. stocks. And if you look at this, the THORdex has been high for quite a while, and it still is at 75, so it sounds like a broken record here, that the THORdex is high, market valuations are high, and you can read that all over the internet and Twitter and so forth about the expectations for where the market should be in the future. Now, some people are saying, the market is at 2%, where the what the THOR index is saying to us, and historically at this level, the returns have been a little bit over 6.5% over the next 10 years. So that is significantly under the long-term range that people expect of a 10, 11% rate of return. So what it's saying to us is that the market is elevated. So that is why we are underweight equities in general in all our models, is because the market is expensive. The other thing that we look at is on the fixed income side. Now, fixed income, there's two areas that we look at. Duration. Do you want to be longer term in duration, or do you want to be shorter term in duration? Well, right now it's saying duration is something you want. So you do want to own a 10-year bond instead of a 2-year bond. Right now, you're getting paid to own those longer term bonds. Credit is still negative for us right now. Credit is looking at high yield bonds and also private credit. This is something that we think that you have to be very careful about putting your money to work in high yield investments where there's a risk of those companies going under. And it's something that we do not want to take at this juncture on the fixed income side. And so we put that kind of all together, and then we look at one other indicator is, are stocks more attractive than bonds right now? And actually we go from a -3 to a +3. Right now we are at about a -2. So what this is showing is that bonds are more attractive than stocks, especially when you're looking at a risk-adjusted return and volatility. Bonds are much less volatile than stocks. So kind of think of it this way: if I'm getting paid 6.5% on a expectation for stocks, but they have 4 times the volatility than bonds, does it make sense when I'm getting 5.5 to 6% on my bond fund? Well, that's why we look at volatility, and that's what the THORdex is. It's a measure of risk, and right now the risk is high. So we sound like a broken record, and we talk about, the stock market is expensive, we are underweight stocks. But go back and look at our videos, what we've been saying for the last year and a half. We have overweighted other areas of the market, especially emerging markets and also gold miners. Gold miners have done remarkably well the last year, and they continue once again in 2026 to do very well. So we are in areas that are not related to the U.S. stock market. And let's look at the performance. Last year, if you look at the emerging market index versus the equally weighted S&P 500 index, you can see in 2025, you made 3 times the return in emerging markets than you did over the U.S. stock market. So that's a place that you should be. Well, this is just not last year. Look at this chart. We've had 15 years of emerging markets underperforming. You go back to 2010, when they first started talking about the BRICS, Brazil, Russia, India, China, and South Africa. That was the rage. Everyone thought the U.S. stock market was horrible. Well, that's emerging markets. As you look at this chart, we're showing, hey, they've outperformed. It was the worst time to be in emerging markets, and we had nothing there. Look at this time period. It's the longest time period that emerging markets have underperformed. So even though, and this goes all the way to 2025, even though emerging markets outperformed significantly last year, in this chart, they're still undervalued. And this is going to switch, and this is just not something that is short term. We like this for the next several years. Emerging markets, we believe, is going to continue to outperform U.S. stock market. As Wayne Gretzky said, the great one, is that he skated to where the puck was going to be, not where it has been. That is what THOR is doing. If you have any questions or concerns about your portfolio or need help, please reach out to us at THORwealthmanagement.com or give us a call. Take care and talk to you in a couple weeks. Subscribe to the THOR channel today.